welcome back. On today's video, we're talking about investing. Investing as a whole, investing in the stock market, and my philosophy to investing. So let's jump right in. If you look at the overall market, this is on Seeking Alpha's webpage, seekingalpha.com. You can take a look at today's market. You look at the down, it is the Dow Jones Industrial Average, it is way down. The S&P 500 crashing, NASDAQ crashing. If you look at gold, of course, it's going to spike, and Bitcoin you would expect to spike as well. Generally, gold and Bitcoin are going to act as an inverse to the market, not always though. So a lot of people right now are looking at the volatility in the market and saying it's a good time to get out. There is an argument for that. There is also an argument for people staying in. If you come out a little bit further, if you look at a 5-day window, the Dow is also way down, S&P 500 is down, NASDAQ is down, gold is up, and Bitcoin is up. Now, why is that? Well, it's because people typically, when there's any volatility in the market, people do what's called flight to security or a flight to safety. People try to get out of what they perceive as risky and get into what they perceive as safe. The broad markets follow this strategy. This is also, in my opinion, the reason the majority of retail investors, which would be the small investors, mom and pop investors, individual investors, this is why they don't outperform in the market. In fact, most of them lose money, is because as soon as things get a little bit scary, they bail and go to something that they perceive as safer, which in the long term generally doesn't work out that way. Now, keep in mind, and this is the obligatory disclaimer, this is not any sort of advice, not investing advice, not stock market advice, not any recommendation of any particular product. I'm just giving you my experience. What I like to typically do in my investing is look at the long-term market. The long-term market. Is the market overall going to go up or is it going to go down? Are the assets that are in the market positive? Are they good solid assets, or are they weak and they should go down? Anytime you have a broad market crash like we're seeing right now, we have to ask ourselves, do I think these assets are going to be worth more money long term? I've been through this in a number of different market cycles, the dot-com cycle, the financial crisis cycle in the 08-09 timeframe. We also saw it with the COVID cycle. We recently saw it with the initial investing in the initial rollout of the tariffs. And what I have seen typically is, as long as I think the United States economy is going to be solid long term, this may be, depending on the companies you go into or depending on the indexes that you go into, this may be an opportunity to buy assets on sale. Now, one of the pieces of advice that you'll get from the industry is don't try to catch a falling knife. And what that means is don't try to catch a stock while it's going down, while it's plummeting, because you never know where it will bottom. And that's true. However, because you never know where it will bottom, this may be an opportunity to actually start buying. Now, there's a lot of pros out there that will say don't buy everything at once, and that's something that I do subscribe to as well. So as I start buying positions in stocks, I will buy them as they're going down and maybe as they start coming up, because you never will know where they're going to bottom. But if these stocks have good fundamentals, if they have good earnings, if they look like they will be in growth mode over the next 5 to 10 years, and as long as I don't need the money for the next 5 to 10 years, this could be a great opportunity to buy some good stocks on sale. So what I like to do when I'm looking at any of these indexes is kind of look out over the horizon, look at the long term, where they've been, and figure out if I think they're going to go back that way. So for example, let's take the Dow Jones. If you look at the 5-day window, it's been horrible. It's been bloody. If you take it out to 1 month, it has not done any better. If, however, you jump out to, let's just do 6 months, you'll see that, yes, it's off its highs, but it levels out a little bit. When we go out 1 year, you see it's gone up, it's gone down. If we go out 5 years, however, we see that while it is down now, it's definitely much higher than it was at its highs back in 2022. And it's well off its lows in mid to late 2022. If we go out to 10 years, yes, this is starting to come down off of its highs, but it is doing much better than it was doing even at its peaks in 2020. If we go back to 2018, 2017, we see that the market generally trends higher. Now, past performance is not indicative of future results, we all know that, but what we also do know is that as long as the American economy has not crashed, has not come to a standstill permanently, has not gone out of business, the market will generally go higher. Now, even if we go into recessions or depressions, generally the market will trend higher over time. And that's why it's important to be investing with money that you don't need in the next 5 to 10 years, or at least that's what I am doing. I am looking at this as this is a long-term investment. If I believe that the American economy or the United States economy will continue to increase over time, then I'm actually a buyer at this point in the market, and I'm averaging in. I'm dollar cost averaging in. I'm not buying everything at once because I don't know how much lower it may go. But I have to believe that the United States economy will recover. Now, as it goes to the tariffs, we can get into that a little bit, but we all should know that this is a negotiating point. Everything has to look worse before it looks better. So that is something that we would expect to see in this type of a negotiating point that we're seeing in the political spectrum right now. Now, the S&P 500 is no different. If you look out at the 10-year horizon, yes, we're off significantly from the highs, but we're well up from any of the highs or lows even 5, 10 years ago. That's what we expect to see as the economy goes over time. A strategy that I kind of put in my own head when we've gone through some of the prior recessions or prior slumps in the stock market is if it goes to zero, we probably have a lot more worries than whatever investments we have. Money's not going to mean a whole lot if the apocalyptic scenario happens. And as long as we don't actually foresee that as happening, we're probably okay. Now, with that said, I never put all of my money in. There's always going to be some sort of reserve, a cushion that I'm going to build so that if I do need money in the short term, I have that available. Also, it's not bad to keep some money on the sidelines so that if it does get worse, you can pick the high quality stocks, the high quality investments that you want, and be able to go into those. The same thing if you look at the NASDAQ. Again, over a 10-year window, yes, we're off of the highs, significantly off of the highs. We're down from 19,000, high 19,000s actually, mid to high 19,000s, down into the about 16,000 range. But that is if you compare it to the highs in 2021, we're at that same level, and that was the peak, and we're now at the valley. So, in my opinion, I think this is a good time to start looking at decent quality or high quality stocks, high quality assets. So, some of the assets that I keep an eye on are Apple, Amazon, American Tower, Google, MasterCard, Facebook or Meta platforms, Nvidia. OLED is a company that produces the TV screens or the material that produces the color in the TV screens, PayPal, Tesla, Visa, all of these are stocks. And I keep an eye on kind of where they're trending, what's going on, and are these stocks that I want to go into. Now, with the political climate, Nvidia may be something that I'm not going to be looking at as aggressively as, because I don't think that the fix there is going to be as easy as some of the other companies like Google or Amazon. But it's still a good high quality growth stock in the short term as well as potentially in the long term with some caveats. We're not getting into too much into individual stocks. PayPal is a great indicator of how spending is going, although their technology lead that they used to have has kind of diminished, where Visa now has online platforms directly and pretty much every company has online platforms that really diminished PayPal's lead. Apple is a great lead or is a great company with the products, and we have to look at what they're doing. Now, am I recommending any of these individual stocks? No, of course not. You need to do your own research, your own groundwork, figure out what kind of stocks are right for your portfolio. But in this type of a market, I like large company stocks, companies that have a solid cash flow, that have good earnings, that have a good amount of money in reserve so that they can weather these storms also. And most of these companies are looking at making acquisitions or shoring up their foundations or doing stock buybacks at times where the markets are down. The other thing that I would like to do is look at the news, and MarketWatch is a great website for this, where you can come in, you can look at just different things, find out what the headlines are, the broad market spectrums are, and then as you're looking at different stocks, you can make decisions on two fronts. The first front is, how is the stock itself? Does it have a good foundation? Does it have good earnings? Does it have a positive trend in where it's headed? That is how you understand the individual stock. The other piece of it is understand how Jim Cramer calls this the Wall Street fashion show. Popularity and emotion actually really does drive stocks in the short term. Finding out what direction the market's going in the short term can help you understand when a good time to buy those stocks is. And that's what I'm looking at in my own portfolio. So, a couple of different takeaways from this video. The first one is generally when stocks are crashing like they are right now, as long as you don't think the economy is going to come to a complete halt and never recover, this could be a great time to recover. To invest. This is the times in my portfolio when I've continued with 401ks, when I've had those, in investing dollar cost averaging into the market. And it has generally worked out very, very well. In the long term, of course. In the short term, it can be very painful to put money in and see the values go down. That is, in my opinion, what separates the long-term investor from someone who is just looking to get rich quick. Sure, you can make quick money in the stock market, but most long-term investors, or most people that actually do make money in the stock market, make it long-term. They understand when good times are to buy. They continue buying into bad times because bad times turn back into good times, and those investments are worth much, much more than they would have been if you just put everything on the sidelines, pulled out of the market, and wait till things recover. So I hope this is helpful to you. If it is, please give us a like down below. If you'd like to see more content like this and a whole bunch of other topics, consider subscribing to the channel. And if you know someone who may benefit from this, do consider sharing. Thanks for being here. We'll see you on the next one.